Good afternoon, everyone. This is Robert Rayburn here at Life Pro Asset Management. It is December 27th of 2022. Now, thankfully, it is the last week of 2022. It's been a tough year. Whether you're an equity investor, a bond investor, certainly our growth strategy has struggled as growth strategies have re-rated. And I want everyone to know that's been in our growth strategy in particular that we don't take performance lightly, and we know it's been tough. I'm invested in growth, and it's you don't like to see those account numbers go down in value. Let's go ahead and get started in terms of this week's update. Now, we titled the week's update, Will the World End in 2023? And we did that for a very, very specific reason. In my entire career, I cannot remember pessimism that is so entrenched, that is so widespread. And it's not just in investing, it's across the economic landscape, it's across the political landscape. And when we see that, typically in the depths of that pessimism is where we start to see the first seeds of the next cycle begin to be sown. And that's where we have spent just so much work in the last, I would say really the last 3 to 6 months, is as markets have headed lower, what are those areas of the market that are actually holding in, that are actually beginning to exhibit leadership in a bad tape and are not considered recession-proof types of stocks? So in other words, have cyclicality, have earnings exposure, but are actually trending to the upside. This is what happened in 2008. The market bottomed in March of 2009, but many sectors and many stocks actually bottomed way back in November of 2008. And if you were paying attention, that is what set the stage and set the map for the next 10 years to make a lot of money. And that's what we're trying to do right now. We know for 11, 12 years, we rode the coattails of the technology and software boom, and we were major beneficiaries of that. Last year, it ended, so we need to adjust. Unlike index funds, unlike other growth strategies that are going to stay in technology forever, we adjust. We know that last year was bad. We know we need to adjust, and we know we need to take advantage of a new growth landscape that is not necessarily dominated by technology. So this week, we're going to look at where's the crowd investing, what are they worried about, and how can we take advantage of that? What is the market trying to tell us with how certain securities are acting? And then trying to align the signals from both the market and the economy to come up with an effective portfolio plan for 2023. Now, according to the recent Goldman Sachs survey, the 3 big, most consensus trades that the crowd, both on Wall Street and Main Street, are making for 2023, short the S&P 500, buy U.S. government bonds, and buy the U.S. dollar. These are huge red flags, of course. So when you get such negativity that becomes consensus, you want to say to yourself, well, what can make them wrong? When everyone's on one side of the boat, generally speaking, the market starts to price that in. That doesn't mean the S&P 500 is going to rip and go to new highs, and we're going to show you why we don't think that's the case. But there's going to be pockets of new bull markets that start to form underneath the surface, and we want to identify that today. The other big thing is back-to-back down years on the S&P 500 are incredibly rare. It's something they're not impossible, but they're very, very rare. So going back to World War II, we've had 21 down years since World War II, but only 3 times have you had back-to-back annual declines: 1974, 2001, and 2002. 2001, of course, was that technology bust that we saw as that bubble unwound. But then, really, it was 9/11 that kind of sealed the deal. So knock on wood, we don't have any type of event like that that would impact the market. But removing those types of esoteric events or unpredictable black swan events, we think that we're kind of more in that 1-year type of stage, even though the S&P is going to have really a ton of moving parts next year. The other thing is, we hear this constant, well, wait for the Fed to cut and then get involved in the market. But history suggests otherwise. The market will start to price in when the Fed is going to slow down and when the market's going to force the Fed to halt its rate increase campaign. And when we go back to Paul Volcker, because that's the big conversation today, Paul Volcker, early 80s, killing off the 1970s inflation, the S&P went down about 27%. So far, peak to trough, the S&P 500 this time around was somewhere around 26, 27% approximately, that peak to trough performance of the S&P 500. It was around that time when Volcker immediately suggested that they're going to shift tactics. And that was what marked the bottom. So in other words, the market bottomed ahead of when the Fed actually and physically pivoted away from rate increases. So that's something we want to pay attention to. We're not saying that's the case today, but what we can say is that as the Fed starts to slow down, and as the Fed begins to contemplate a world above or beyond, beyond peak inflation, what are those pockets of the market that we can take advantage of? So how do you make money? We talked about this in the prior weekly update, which is we want to identify areas of improving relative strength as the market has headed lower, assets that have bottomed ahead of the overall market. So are there stocks right now in sectors that are breaking out while other things are hitting 52-week lows, such as technology and software? And then, of course, we want to avoid areas of leverage and falling relative strength. What we don't want to do is to try to catch a falling knife, right? So when we look at the action in technology, when we look at the action of certain pockets within the consumer space, it's easy to chase those names and say, well, they were market leaders last time and now they look really cheap. Yeah, but they're still sitting 50% above many price levels from back in 2018 and 2019. So we got to be careful. We have to pick our spots and identify those pockets of bull market potential in a very pessimistic tape. You know, one thing that we got right, but then got wrong, because we quite frankly got chicken little in late 2021 and early 2022, is that our prime thesis on energy in 2021, that it was only 2.5% of the S&P 500. We want to invest now because technology is going to unwind and those cash flows are going to find its way into energy because of the inventory shortfalls. We were right, but we were wrong. Technology continued to run. And then we chased performance a little bit, and we should have stuck with our call and stuck with our process, and we would have been right on that energy call. The good news is we think energy, as we said a year ago, is in a multi-year bull market. But in addition to that, a new development has taken place. Copper, its inventory shortfalls, iron ore, its inventory shortfalls, the massive underinvestment in coal and metallurgical coal that goes into steel furnaces. All of these are facing major shortfalls. And when we look at tech and communications at 34% of the S&P 500 versus energy, only 5%, materials are only 2.76% of the S&P 500. And then you delve into that, metals and mining, only 0.45% of the S&P 500. As all this cash leaves technology and software, and communication and advertising and social media, I think all of this is going to find its way into these major small components of the market, and it's going to overwhelm those stocks and send those stock prices higher as the demand for exposure in areas of improving relative strength take place. We think these three components are the major pillars of the next bull market for the S&P 500. If you want to outperform, we believe that these are going to be the three major components that define the 2000s, in addition to the industrials. And a big reason why we like gold in particular is what we see happening with the US dollar. When gold goes into a bear market when US dollar is strong, because it's a currency to hedge against the reserve currency at the time, which is the US dollar. Notice, dollar strength, gold bear market. Dollar weakness, gold bull market. Over the last 10 years, dollar strength, gold bear market. US dollar started to break down. And we see that not only taking place against the US dollar for gold, but gold relative to the S&P 500, as we see here, the chart on the left, and then gold relative to technology stocks. We believe that we are in the era of rock over paper. From 2010 to 2022, or 2021, pardon me, it was about paper over rock. This is about physical things, rocks, energy, those types of things that act both as a store of value and a use for physical economic activity in the US and abroad. We look at energy. These inventories, the chart here on the right, have only continued to sink to new lows. Meanwhile, the S&P 500 energy sector, while yes, it has performed remarkably well this year, is still near its low point relative to history. We do believe that energy, especially now when you're thinking of almost every country is dealing with an economic malaise to some degree, as these economies rebound, there's going to be an inventory shock. We only saw today, or pardon me, on Friday of last week, where Russia announced they're likely going to cut output by about, anywhere from 6 to 10%. That's the second largest oil producer on the planet during an economic upswing potentially. So this is important. We want to pay attention to these things. And then lastly, of course, inflation does appear to be slowing. We're not saying we're going into a low inflation environment. What we're saying is we believe we're increasingly past peak inflation. So we look at the 3-month average, the annualized average of the last 3 months of CPI and PPI, we've gone from 11.1% all the way down to 4.18%. We've gone from, 11.1% on PPI, core PPI, all the way down to 2.69%, and then all the way from above 8% down to 4.18% for CPI. These are major, major numbers. And when we strip out the shelter inflation, which I get it, you have to include it, but if you strip out shelter inflation, we've actually gone negative, believe it or not. And you've seen that in gas prices, you've seen that in food prices, et cetera. So what's the bottom line here? It is easy to be negative, especially after a hellish 2022. There's no doubt about that, right? It's hard to be pessimistic when you look at your bank account. But remember that pessimism does breed that opportunity we look for as markets as a whole start to diverge. Certain areas are going to act well, certain areas not act so well. We want to take advantage of those new emerging bull markets. That's what we got for you this week. It was a little bit longer. We wanted to preview what 2023 we think is going to be all about. But we also want to thank everyone for their business, for their friendship, for their patience. We know it's been tough. We know that it's not easy going through a bear market, but we are confident that we can get this strategy back to where it was at the beginning of 2022 and beyond. And for those who are interested in our other strategies, then we can definitely have that conversation as well. Blue Chip had a great year this year, as well as our new enhanced income strategy. So give us a call or reach out to your advisor. We're glad to have that conversation and get detailed about the game plan. Thank you again. Have a wonderful holiday season. I hope that everyone had a very Merry Christmas, and we'll talk again soon. Talk to you later. Bye.